The premature speculation Santa Claus rally is over. The S&P 500 will fall further. As the Fed just engineered a winter of depression, the S&P 500 scaled higher last week when Federal Reserve Chairman Jerome Powell indicated a downshift in the size of rate hikes. But now those price gains are gone, and more stock losses are on the way. So the Powell pump has been erased. The premature speculation Christmas rally is over. Wall Street traders always like to get excited way too early. We finally see what we have been waiting for. Stocks down as long bonds like TLT keep going up. Also, we are seeing oil down to $74 a barrel. Whenever OPEC said they are cutting production, that means the oil price might drop. Because the reason they have to cut production is because they've already overproduced. Deflation is strong at the moment, but tomorrow it can change again. Oil could suddenly spike higher. One thing is for certain, winter is coming. Will it be a mild recession or a dark depression? New inverted yield curve data will show us the light. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get it into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? The S&P 500 shot up by 3.1% to 4,080 last Wednesday after Powell in a speech said signs of easing inflation may result in a smaller rate hike this month. The index has since dropped by more than 2% through midday Tuesday, giving up the 4,000 level once again. A few hotter than anticipated economic reports arrived from Powell's Brookings Institution speech, hurting stocks as investors worry the data will encourage the Fed to raise interest rates above 5% before the rate hike cycle is paused. Among the reports, the November U.S. jobs report beat expectations, with the economy adding 263,000 and activity in the services industry unexpectedly strengthened last month. That said, there's not much further in terms of fresh bearish macro triggers. So it remains to be seen how much further this downward move can go and whether the bulls will step in once again at these levels. Stock market bears so far this week have successfully defended the key 4,077 resistance level. A lower low beneath 3,936 would further excite the sellers and scare away the bulls, especially on a daily closing basis. That's because we will then also have seen the breakdown of the bull channel. Stock investors may have already fully priced in an anticipated rate hike of 50 basis points at the Fed's December 13th and 14th meeting rate hike. and a reduced tightening pace thereafter. This may therefore keep a ceiling on stock prices. Fears over a looming recession may also discourage investors from piling further into the stock markets after what has been a very impressive recovery in the last couple months so far. Wall Street has cautioned that the Fed's aggressive round of rate hikes this year will tip the economy into a recession. JP Morgan CEO Jamie Dimon on Tuesday also flagged the prospect of a contraction. Inflation is eroding everything, and that $1.5 trillion will run out sometime mid-year next year. So when you're looking out forward, those things may very well derail the economy and cause this mild to hard recession that people are worried about. The November inflation reading will arrive on December 13th, a day before the Federal Open Market Committee releases its latest policy decision. October headline inflation was at 7.7%, easing from a 4-decade high. The Fed funds rate is at a range of 3.75% to 4% after 6 rate increases in 2022. Dimon expects the Federal Reserve to hike rates to 5%. And hold them there for several months, but warned even that may not be enough to bring down inflation back under control. His forecasts come as residual lockdown savings that have been propping up consumer spending start to run out next year, with Fed rate hikes weighing further. Comments from Fed Chair Jerome Powell and other central bank officials have left Dimon expecting a peak rate of 5%, which would be the highest since 2007. He then sees the Fed holding rates at that level for about 3 to 6 months, but added that may not be sufficient. Other risks to the U.S. economy include the central bank's quantitative tightening campaign, persistent and stubborn inflation, and geopolitical tensions that could worsen oil, food, and humanitarian crises. We've not had a war in Europe like this since 1945, and back then we said never again. Add to that, by the way, and a lot of emerging market countries that a lot of people don't focus on are going to pay a heavy price to the strong dollar. Higher rates and higher oil prices. And so that stuff is really significant. I don't think we've seen that kind of turmoil in the global world in a long time. 500 basis point of rate cuts on deck. Powell is fighting weight of history with higher for longer. The inverted yield curve shows why Fed Chair Jerome Powell is fighting a losing battle in his desire to keep policy restrictive for an extended period without a radical re-upping of the Fed's hawkish ant. Pressure is likely to remain on the yield curve. Like an obstreperous child, the Fed sometimes has a hard time getting the market to do what it wants, and sometimes enlists journalists to help in its aim to keep rates for higher for longer. The market has listened to the Fed on the first part by bringing forward the expected peak funds rate and pushing it higher. But it has resolutely ignored it on the second part, pricing in deep cuts that happen soon after rates are expected to peak. This is keeping pressure on the yield curve, leading to the deepest inversion in 2s, 10s since the early 1980s. I looked at this last week, and there is a strong relationship between the peak size of the curve inversion and the subsequent total Fed rate cuts, this time adding in the two 1970s recessions. When lowering rates, of course, the Fed can cut more if the starting rate is higher. We can account for this by looking at the percentage cut from the peak rate. This leads to a weaker but still non-trivial relationship. It also leads to a negatively sloping line as falls from lower starting points, such as 2007 and 2020. Cutting cycles are large in percentage terms. Nonetheless, the current inversion of 2's 10s is historically consistent with 65% of cuts from the expected peak Fed funds 5%, i.e. 325 basis points. If we get a recession, there is a tautological aspect to this. A more inverted curve gives the Fed more room to cut. The Fed raises the stakes by saying it'll keep rates high for a prolonged period. But the market calls its bluff and says the economy can't handle it and bids up longer-term bonds, flattening the curve. Ultimately, though, in a self-fulfilling manner, the market wins and the Fed cuts, re-steepening the curve. Both relationships would infer, but not necessarily predict, much deeper Fed cuts than the 160 basis points currently priced in by the Fed funds curve if we get a recession, which looks highly likely, as long as the Fed keeps on insisting on higher rates and inflation keeps falling. History favors a larger Fed pivot and continued pressure on the yield curve. The Fed may live up to its own hype and keep rates very restrictive, but talk is cheap. And the truth of the matters is the Fed has not yet had to face the pressure from keeping rates high, continuing with QT while unemployment is beginning to materially rise. In the 1974 recession, the Fed cut rates almost 800 basis points in a period where inflation was above 9%. And my client Teddy Eazzy's book, Wicked Pussy Perfume, it is an erotic novel. Such an amazing book. Order your copy for Christmas. And my client Juliana Wood, this is Burning in the 2020 Flames, another awesome book. And my book, Treasures Within Our Heart. You are such a good boy for watching my video right till the end. Bye.